Let's bring in Jonathan Barratt, who is Managing Director at Commodity Broking Services, joining us from Sydney. Jono, let's start broad on this. You heard the comments coming out of Davos. We saw the whole commodities trade track lower overnight because of fears that the ECB will hit the trigger and raise interest rates, perhaps choking off some growth in the economy.
Yeah, Karen, it appears that is the case. I think what we're seeing is people moving away, looking at those trades which don't rely on growth. I mean, China's already started. You see what's happening in Europe. They might start as well. They're slowing because people are concerned of that inflationary pressures coming through. And I think that's the key going forward, is where is that inflation going to come from? And when you look at where commodities are placed, those primary inputs are placed at record highs or close to record highs. It's a real concern.
Jono, the crisis in Egypt, are there any implications for the oil market? Hannah Sabra, the Eurasian Group, says this, that unrest will unsettle energy markets. Thousands of oil tankers pass through the Suez Canal every year. Should the market be factoring in disruption in the Suez Canal at this point, or is that a very remote possibility?
Sri, I think at the moment it is something that's on the radar. I think it is obviously a remote possibility. But whenever we do get those concerns, particularly in the Middle East, we do start to factor in a risk premium. But when you look at the price action, it's not apparent at the moment because we're still seeing those inventory builds. We're still seeing the market certainly under a lot of pressure. But I think if it continues to escalate in that region, that would be an option for people to actually start to buy crude as a result. So I think we need to see more of an escalation before that premium is actually factored into the market.
You know, John, I've got to ask you here, we've been talking broadly about inflation, input costs, commodities, etc., wages, etc. The news flow overnight, S&P knocking down Japan's debt rating, Moody's warning on the outlook for U.S. debt. Seems to me that the thing we should be watching out for is the cost of risk, the cost of money going up. If that is true, if that is a real worry, what does it mean for gold?
Look, I think gold's at a very interesting point because it's already had a bit of a correction. It's off close to about $110 off its record highs. I actually feel that it should be more supportive, but I think what we are seeing at the moment, Martin, is that we're seeing a lot of people moving away from gold and into equities and other assets. Because remember, when you look at the ETF and the actual drawdown in holdings in ETF, it's been quite sudden, the movement.
Yeah. So
I think if in fact that cost of money increases, that could actually say to people that, hey, there is more of a concern out there, and then we'll get that economic concern coming back into the fray, and that then should support gold. But at the moment, my concern is that the amount of people moving away from the ETFs and into other assets, which will always keep a top on gold at the moment. But I actually like to think there's a bit of a low round here for gold, around that 1320 area, from which I can actually buy or re-enter into the market.
Okay.
I guess we should disclose here that you are sitting long gold anyway, Jono, but if you look at the fundamentals in gold, is one of the issues too that there just isn't a lot of physical buying at the moment because the gold price has climbed so high?
Well, you tend to find, Karen, the physical people will come back into the market, but this is a traditional period when the physical market is on holidays. When you think the Christmas, the Indian ceremonies, all those sort of seasons are out of the way. So the physical guys will be on the back foot. The increase in physical demand is from the ETFs, but having said that, we've also seen an increase in physical demand for jewellery. And jewellery's up around about 19%. So I think in the advent of those physical players not being at the moment, particularly from the ETF market, it's really up to the speculator and or the hedgers to take advantage of where the price is. And I know if I was a producer, I think I'd be actually starting to put some hedge in at the moment.
Jono, Sarkozy is pushing tighter regulatory oversight of the commodity markets as one of his big themes for the G20 at the top of his agenda. Is this the beginning of a regulatory backlash on commodity markets, especially the agricultural commodities?
Look, Cherie, when you look at it, you've just seen the two rice traders in Chicago being pulled up for over-trading. I think it's a solution that is going to be very hard to find a balance between traders and speculators, hedgers and investors, because within the markets it certainly creates an area of liquidity. And as soon as you take that liquidity out of the market, you're not going to find the right ability for people that really need to hedge to be able to come into the market. Now, what we are seeing is an increase of sovereign wealth funds actually playing in these markets, looking to protect their own economies. So if you take out that speculative edge out of the market, then these people won't be able to hedge their needs when they need to, and you'll get more volatility. So I think it is a very, very tough question to solve, and I think it's going to do a lot more work, or a lot more work is needed, because you can't take liquidity out of these markets because so many people rely on the prices to benchmark their own pricing for sales.
When you're talking about sovereign wealth funds, they're hedging, John, are you talking about the likes of the Asian countries, China?
China, across the board, India, but also I think we're seeing a lot more play by the governments to be involved in more of the agricultural spaces. When we're seeing the La Nina effect at the moment going through the market, that's going to cause great volatility in the grain markets. I think that's going to continue for some time. As a result of that, we're seeing more governments stepping into the market to try and hedge themselves, protect themselves, to stop exports. And I think that's sort of suggesting more protectionism actually come into the fray in the agricultural markets, because, the La Nina is an effect. It's going to continue whilst it's there, and it will adversely affect the production of a lot of our soft commodities. So it is an issue.
Okay, listen, John, great to talk to you. Thanks for your time. Great weekend. Do it again soon. Jonathan Barratt there, live down in Sydney.